Good morning, everyone, and welcome to our panel on the GCC market. Whether this is your first time or you're joining us again, we are very delighted to have you here today. As we move in 2026, a lot of the uncertainties that shaped the market last year continues to be in place this year. The geopolitical risk, the tariff frictions, and the commodities fluctuations, just like the one that happened last week, and the one that's happening right now, is continuing to influence the global capital flow and the investors' sentiments. For the GCC market in particular, the geopolitical developments and the oil market drivers are key variables that is impacting the equity market performance. At the same time, the global backdrop is evolving. So growth is moderating, inflation pressure is easing, and the central banks are navigating the timing and pace of rates adjustments. All while the market remains to be sensitive, just as I mentioned, to geopolitical and trade-related risk. However, regionally, the story is more constructive. The GCC markets continue to accelerate their diversification agenda by investing in infrastructure, technology, tourism, and many other non-oil related sectors. Nevertheless, the regulatory reforms, such as the mortgage loan in Kuwait or even the foreign ownership in Saudi, remains to be valid and very important for the markets as it increases the passive inflows and it's reshaping how investors are thinking about accessing the market. So today we will be focusing on four main areas. Just like I mentioned, the market drivers, what sectors and themes we should be playing and what themes we should be avoiding this year, the GCC market in the emerging market context, and finally, with all the discussions we're going to have, how can that be shaped into a concrete investment strategy? So with our panelists, we're going to start the discussion. Jassim, starting with you. So we saw the Saudi market last year. It has underperformed significantly compared to the emerging markets where it rallied. So in your opinion, I have these questions. Question A, to what extent was this driven by geopolitical and oil prices volatility? And B, do you think that's going to continue to happen in 2026? The floor is yours.
Thank you very much, Sarah, and it's a pleasure to be here today. 2025, I think it was a year where the most global equity market rebounded significantly and recorded a new high. Like MSCI Emerging Market Index increased by almost 35% and even outperformed the US market. However, Saudi stock market declined by almost 13% and marking the weakest performance in a decade. So the main question today, why did Saudi market diverge while the global equity market rallied on AI and rate normalization? Yes, I might agree with you that one of the main reasons is the geopolitical expansionism and also global trade tension, which has impacted the investor sentiment. But I do believe there are two main headwinds behind this pressure. The first one, I think, is the energy landscape, where the oil market faced structural oversupply last year and even impacted the oil price after we saw almost 20% decline in that energy price. So this kind of weak prices not only impacted the government revenue projection, but also impacted the valuation and earnings outlook of the top heavyweight sector in the market related to the energy. The second factor, I think the liquidity tightening, where despite the healthy money supply in the system, the acceleration credit growth fueled by giga project has impacted the liquidity in the banking sector and also impacted the liquidity in the market. So overall, I think these two factors or issues start to ease beginning of this year, and the market now trading at a very heavy discount, which over a very good opportunity for the investor in the long term.
All right, thank you. And Abdullah, how do you think those drivers impacted the market? Did it create maybe opportunities or maybe strategies for the markets?
I think what's really interesting to observe, and I'll take a different angle than my fellow panelists here, is on the fixed income side, as that's a big part of capital markets. So if you look on the capital flows on that side, last year there was about $160 billion in issuances between sovereigns, GREs, and corporates in dollar terms. And there was very strong demand across the spectrum. We saw the Kuwaiti sovereign issue around $11.25 billion towards the end of the year. And that was heavily oversubscribed many times over in demand. And that priced at just 40 basis points over treasuries. You see corporates and banks especially tapping markets with order books that are many times over subscribed. I'll point out Burgan's paper as well. Towards the end of the year, senior paper over 3 times oversubscribed, priced at where investment grade paper prices on a global level, and also the rest of the industry. But what I'm trying to point to is, with all this noise about geopolitics and oil and what's going to happen and risk, etc., you don't see that where the smart money is.
Yeah.
There's a lot of talk, there's a lot of discussion about it, but the reality is the flows are coming from a global basis here. And while, yes, there is volatility in oil prices, and there is an undeniable geopolitical charged environment, but the reality is it doesn't change where flows, capital flows are going, and it doesn't, and the market is resilient in that way.
I do agree. I mean, the market is going through a lot of changes, and there are some fundamentals that can actually support that. Moving to Thomas, from a buy-side perspective, how are you seeing those drivers impacting the market in 2026?
Thanks, Sarah. Pleased to be sharing my views. I think for the GCC, it's about systemically reducing or mitigating these spillover risks from geopolitics or even geoeconomic fragmentation. And it really entails focusing on controllables amidst oil price volatility and commodity price volatility. Now, if you look at the individual economies and how they're managing it, it's about the rate of change and the scale of change. If you look at these economies, each of these economies are in different stages. You have economies who, if I can borrow a venture capital term, are in that 0 to 1 sort of stage of their diversification journeys, and you have other economies like Saudi Arabia who have been through this entire diversification journey for slightly longer. And if you look at Saudi Arabia now, at this juncture, what they're essentially doing is they're also using regulation in terms of foreign ownership laws for deepening their capital markets, and also they're deepening their real estate in terms of foreign ownership and opening it up for foreigners. If you look at UAE, they're sticking to their core pillars of logistics power, and also pivoting towards some of their advanced manufacturing and technology pillars as well. If you look at Kuwait, Kuwait is in an unprecedented stage of its reforms pushing ahead. And you see that these countries, even though they are at different stages, they are sort of mitigating this risk by clearly following plans which are set for them. So the long-range plan for these countries are set in motion, and it's about consolidating on this year by year. So you find winners out of these industries coming forward.
And building back to Justin, building on your point about the mega projects, we know it is a catalyst for all the markets in the region. But how can you translate the impact of that on the Saudi market in particular, and how is it creating opportunities in the market?
Yeah, looking into 2026 year, the data points to a resilient fundamental at the macro level, as the kingdom ambitious plan is to diversify its economy through the Vision 2030 Giga and Mega project, which will definitely reduce the reliance on the hydrocarbon activities. Also hosting the major global events like the international sporting events and Riyadh Expo 2030 will also help the country in terms of achieving its ambition to become a global hub and to drive growth through other multi-sector like hospitality, tourism, retail, infrastructure development, and so on. So had 2030 vision not implemented, I think with the latest decline in the oil price, this might cause a severe crisis to the government budget and spending and deficit. But instead, Saudi Arabia has already diversified its economy through last few years, where the non-oil GDP today growing at 5% in the last few years.
How much?
Compared to much lower rate, and even the contribution, which is more important, from non-oil GDP by 2025 reach almost 56%. Yeah. This is compared to below 45% pre-2030 vision. And the last point is the national debt to GDP remain very low at 29% as compared to almost average of 80% for G20 countries, which provide a very strong support to the country against any oil price volatility.
And Thomas, since we're talking still about the equity, we would like to then talk about the debt market here as well. But talking about the entire region, the GCC markets, how is that impacting the rest of the region?
Maybe I can just talk about Kuwait a bit, because we are in the thick of an unprecedented push of reforms which are pushing project activities. So clearly the building block for reforms and progress is infrastructure, and the flywheel for growth has been set in motion. What that entails is, if you look at project activity across ports, the power, telecom, it's been growth over the past few years. If you look at project activity awards in 2025, Kuwait witnessed over a 50% jump in project activity awards, and against a declining backdrop in some of the other GCC countries. Maybe I could give you some examples as well, which shows the rate of change that Kuwait is sort of recording. If you look at, let's say, the government project activity, in just one quarter, Kuwait has actually completed 44% of its annual 25-26 fiscal plan for project spending on the government side. If you want to look further beyond that, you see the Kuwait Authority for Partnership Projects tendering 23 projects for real estate in the market. You look at the progress with the Mubarak Al-Kabir report with 8.1 TEUs, and see the multiplier effect that will come into play. That's another area where there's a lot of action. And overall, you see what this does is you will find that there are cascading effects for the industry beyond that as well. So if you look at, let's say, a metric, which is the S&P Purchasing Managers Index, which the business optimism from corporates has been at highs which are not seen since 2018. So it's at those highs, whether it's orders outlook, whether it's employment outlook. And so this is clearly an example of how growth has been set in motion for the country. And this is all happening in the backdrop of where, in the EM context, active EM managers are still underweight Kuwait as compared to the benchmark. So you see the opportunity set
so
right there.
So them coming in is a huge deal for the market.
Absolutely.
Actually, yeah. Thank you so much. And Abdullah, I'm pretty sure the same thing goes to the debt market. So what do you think the impact is?
I think what's interesting to see is not just the headline numbers, but where the risk actually sits, or where the capital flows. Last year, there was about 130 billion of issuance in corporates and GREs, as opposed to, or in comparison to, 80 billion only in sovereign issuance. So you see the funding for these projects going to the entities actually working on the projects, the project companies, and the banks financing them, rather than sitting on the the pressure on the ministries of finance and the fiscal outlays of these countries. For example, Thomas referenced Kuwait. You see KPC has plans of spending 30 billion in capex over the next few years, upgrading to 4 million barrels a day and tapping into the Jurassic gas. And that translates into 10 billion a year of spend. We're already in the beginning of this year, we were seeing over $2 billion of that showing up in tenders. So what does that mean for the market? That means that the funding mix is changing, and that creates a broader investable universe that you can get exposure to. Also on the fixed income side, through these project companies and GREs that are doing the projects themselves, not having to play the sovereign play.
Which proves that regulatory reforms is very important for our markets, right?
Correct.
So, I mean, Jassim, we're super fortunate today, and we're very lucky to have this conference today, because just yesterday we had the implementation of one of the regulatory reforms in Saudi. So my question to you, with those changes in regulations, how is that translated into the market, and how can it create opportunities?
Yeah, I will cover that question specifically on Saudi market. Actually, I think 2026 is a pioneer year for market openness due to the latest regulatory change, as you mentioned. So 1st of February, the government has officially opened the market for the foreign investor, both retail and institutional, and removed all the previous restriction. This kind of direction, along with the expected increase in the foreign ownership limit in the coming few months, this might attract billions of dollars to the market. So this kind of restriction removal, I think this will result in 3 main positive results for the market. The first things, the Saudi market weight in MSCI, it might increase, and this will be based on the passive fund from emerging market. And this will also increase the liquidity in the market and also enhance the market valuation. And the last point, it might be reflected on the trading participation from the institutional side, where the institutional side participation reached to almost 55% last year, as compared to 9% 4 years back.
Only 9%.
Yeah.
All right.
Yeah. So the change in regulation is not only limited to the equity side. We saw a new regulation in the real estate as well, where the government allowed the foreigner to participate in the real estate transformation. So to summarize, I think while 2025 was a year of valuation correction, the kingdom enters 2026 with a diversified investment hub and opening its door to the international capital.
All right, that's very interesting. I'm looking forward to this happening in this year. But Thomas, going forward, how do you see that is reflected into the asset allocation?
I think simplistically, if you do the top-down, it's always following the beneficiaries in terms of sectors. But if you look a little more deeper, it's about how the transformation of profit pools is evidenced, right? So typically, you'll find the bellwether sectors like banking and energy, you'll find a transformation of how these profit pools are transformed into other sectors like industrials, transport, logistics, and you have that pack, you have winners out of that pack which sort of emerge as well. So that's a good way to sort of position or allocate in terms of your equity participation. If you look at also these events which are regulatory announcements and regulatory initiatives, what they typically do is they also have a market level anticipated premium, which investors do allocate to a lot of the names, which creates dislocations as well. And that's opportunity.
Creates opportunities too.
Yeah, hunting grounds for stock pickers and bottom-up stock pickers, which we've discussed a lot in our discussions as well. So that's typically how you would probably allocate during these once in a lifetime sort of initiatives, which are announcements from the regulatory side.
And Abdullah, what's your take on the regularity shifts?
Again, focusing differently from the credit side, what's important for that side of the market is clarity of execution. And I think the regulatory reforms, like Jassim mentioned in Saudi Arabia, you see GREs, corporates, banks coming to market with standardized documentation, standardized processes, book building process. it looks and feels like the investment grade and fixed income transactions that are happening elsewhere in the world. And that reduces risk and creates the ability to price multi-billion-dollar order books in just a matter of hours, and with tightening of expected yields from initial price targets to where they close in the end, with a lot of flows. And you see the same thing also in Qatar and UAE and Kuwait, where you have, especially in Qatar and UAE, repeat issuers with big programs, and they benefit from lower yields. And what this means is, because of these regulatory advancements and improvements, there's less risk. So investors like Kathy, when they look at our region, when they look at our markets, they don't think about, oh, is this market going to work or not, etc. And they focus more on analyzing the credit, figuring out where they want their investments to sit, and where on the capital structure, rather than is this market going to work.
Yeah, I agree. It helps a lot in asset allocation as well. Thank you so much. That was very insightful. And now we're going to move to my favorite topic, thematic investing. So Jassim, speaking about all those market drivers and speaking about the regulatory reforms as well, where do you think investors should be investing this year? What sectors are looks appearing with opportunities this year?
Yeah, when we talk about thematic investing for Saudi Arabia, I think the key is to identify the key sector that align with the economic shift in the country. So a prime example for that is the construction sector, where it's the main beneficiary of 350 billion giga and mega project in the pipeline, and will definitely support strong demand for infrastructure and building materials. Also, tourism and logistics is another promising example for this theme, where we already recorded almost 122 million visitors last year and exceeded the initial target by 2030 of 100 million. And also we saw a spending of almost 100 billion riyal, 300 billion riyal last year on this sector, which might position the kingdom among the top 10 countries in this sector in the next few years. The third theme, I think it's the pharma producer and healthcare.
They did have this regularity changes a couple of years ago, right? To privatize the prescriptions and so on. So
exactly. So for pharma producer, the direction is to localize 40% of the medicine production as compared to the current 50% only, along with healthcare privatization and also the implementation of national insurance plan on the citizen. All these factors might drive the volume growth for this sector.
And what about the banking sector? I mean, it is a huge market. It is a huge sector in the market. So is there any opportunities, or do you think there are more challenges because of tightness? What's your input?
Yeah, because despite the current short-term pressure, I think the Saudi banking sector is still promising. The sector itself is trading on a very heavy discount right now at around 20% as compared to the historical mean. And the loan growth remain robust, which might mitigate the impact of cost of funding right now. But the main challenge, as you mentioned, may be the liquidity issue, which I think it might ease in the coming few months, because when we look to the government direction in terms of increasing the oil production this year by almost 1 million barrel a day as compared to last year, this will definitely ease this issue in the coming few months.
And on the flip side, it is very important to know as well what sectors maybe we should avoid or underweight this year.
I think disciplined investing in 2026 required to be cautious in some specific theme and certain sector. I might start with petrochemical, with the let me say, structural oversupply in the sector, which might take quite longer time to rebalance again. So it's better not to overexpose to that sector. The second theme might be the retail staples. This is mainly due to competitive environment, so we need to be picky in choosing the name.
So you're more of a stock picker there.
Yeah.
All right. And Thomas, when we talk about wider regions, so in the GCC market, how are you seeing, where should the investors position themselves? What sectors should they actually participate in?
So I think if you look at themes from the GCC, you look at the country-specific themes. I think Jasim alluded to some of the themes in Saudi Arabia, which will do well. In Kuwait, it's specifically going to be the industrials, which will do really well. And if you look at that industrials, cap goods, building materials bucket, there should be winners there, profiting from this transformation of earnings pools. And if you look at maybe UAE, you will find UAE still doing well on the infrastructure and the real estate side. I just wanted to mention about the real estate side in Kuwait as well. There will be beneficiaries from these real estate housing projects as well. And also
which is
Kuwait,
a huge catalyst for the Kuwaiti market right now. Yeah.
Yes. And for the Kuwaiti market, even if you want to position yourself on the funding side, whether it's to be an ultimate beneficiary of the mortgage market or even the corporate loan growth, which comes from corporate loans that originate from these macro reforms, that's also a play in that side of the market. In the UAE, it's obviously real estate and infrastructure. In Qatar, you're more selective with LNG expansion themes around the North Field expansion. So if you're looking beyond this at probably GCC themes as a whole, sectors which can be picked from each of these countries, you could probably even look at the transformation of how data centers are becoming a viable choice. And there are some plays there in the market in the equity space, whether you want to look at specialty data center plays or if you want to look at cloud services or managed services which are built on top of it, or even if you're looking at a slightly risk-averse sort of allocation, you can even look at the telecoms who are looking to attract hyperscalers with their data center offerings. I think beyond this, it is, Jasim alluded to tourism as well. It's still the sector which, barring the UAE, all the other countries in the region don't have an allocation of even 10% of GDP to tourism. And it's still the sector which is the largest originator of jobs, which means that there's room to grow there. And even as that room to grow closes, you'll have cascading effects to other consumer spending with origination of jobs, etc. And maybe if for the flavor of the times, if you have the stomach for it and the risk appetite and you want to go up that risk curve, you can even look at the mineral chain and rare earths, which have some plays in the region as well.
But then what would you avoid in the region as well?
Well, to be honest, I think...
Because we mentioned so many things that we like, right?
Yeah. Yeah. So I think there are certain consumer plays which don't have catalysts or earnings catalysts, and maybe at different time down the year you'll probably find them more attractive if you find some correction in those names. But at the moment they seem full in terms of valuation. Also some parts of the capital goods value chain where there is order book depletion and there's no visibility of new orders. That's probably parts of the value chain that you would probably avoid as well.
All right. And Abdullah, what is your intake?
Just briefly, that while these are great ways to play these themes through equities, you can also play the same themes through fixed income investments in the region. So the same themes, banks, infrastructure, capex, development, you can do that. For example, on the bank side, you can also play the capital structure. So you can go into AT1s, Tier 2s, where you pick up 6 to 7% on those without really taking additional risk. And on the development and projects and infrastructure, you can buy Saudi Electricity, ADNOC, etc. These GREs and project developers, where they price even wider than where their fundamentals would predict. And you can play those same themes through fixed income.
And as we mentioned earlier, I mean, foreign cash flows, foreign inflows into the market is very, very important. And being part of the emerging market makes it even significant. And we've mentioned earlier that we're already underweight, the foreigners are underweight in our region. So if they come back to the region, how much are you expecting that to impact the inflows in 2026? Maybe Jassim, you can start with them.
Yeah. When examining the size of Saudi market, I think it's the largest in GCC market and accounting for almost 80% of the IPO proceed in the region. And also in terms of valuation, the market capitalization of Saudi market exceeded today $2.5 trillion, which is quite significant, but it's quite smaller compared to the giant emerging market like China, India, South Korea, and Taiwan. And it's smaller as compared to their weight in the MSCI emerging market, where Saudi market account for only 3.3%. And this is mainly due to foreign ownership limits. So any potential increase in this regulation, it might attract billions of dollars, and it might also increase the weight of Saudi market in MSCI emerging market. And also in terms of foreign investor activities, the ownership of free floating shares of foreign investor jumped by almost 6 times in the last few years, from 1.5% in 2019. Today we reach almost 11.2% of the total free floating shares in the market. However, this kind of percentage is still very low compared to some mature emerging market like Taiwan and South Korea, where the foreign ownership in their market exceeded 30% after they removed the limit on the ownership. So again, as we expect in the next few months, there will be some change in the FOL regulation. This might attract between 10 to 15 billion dollars to the market. This is not just theoretical. Yeah, this is not just theoretical. We saw a huge net cash inflow last year despite the market pressure.
And Thomas, what do you think?
I think on the FOL side, just wanted, I think Jassim has alluded to all the points regarding Saudi. Just quietly under the radar, you found Kuwait closing 2025 with a net foreign buying which went up 3 times as against 2024. And still you find active emerging market investors underweight Kuwait as
there are still
compared.
more
There's still a runway
yeah.
there clearly as well. So in terms of the GCC pitch, it's quite simple, right? It is top 5 in terms of market cap if you take it as a composite, top 5 in the MSCI emerging markets. Now, where do investors, EM investors, find, how should they allocate to the GCC? It is as a de-risking part of that EM portfolio. And if you look at the data over the last 5 years, if you look at the net USD annualized returns, the GCC has outperformed the MSCI EM by more than 500 basis points. It goes quietly under the radar again, and also at much lower risk-adjusted returns. So if you look at volatility in terms of standard deviation, it's lower than the MSCI EM as well. So there's clearly a lot of potential there, and it's also a testament to all the growth and all the initiatives and reforms which have been enacted by these governments. So that's really great. And also, if you look at the factor exposures, if you look at the EM basket, it's typically tilted towards momentum. But if you look at the GCC or the MSCI GCC, it's more low volatility, value, yield. So it finds a great place in the portfolio of an EM investor. And you will see these gaps in the underweights that you see for these markets closing soon.
All right, and Abdullah?
What's interesting, this dichotomy and capital flows and the perspective of foreign investors towards the region shows up clearly in the differences in the perception between equities and fixed income, where, for example, the GCC is no longer a small satellite within any EM bond investor. It's now a core part, a big part. For example, last year alone, the issuances that I referred to, over $150 billion, this represents over 35% of global EM issuance, excluding China. So if you're an EM bond investor, like Kathy, you can't pass up on this.
Yeah.
This has to be a core part of your strategy, a core part of your holding, and it is the index at 35%. And mind you, that excludes Kuwait and Qatar, because last year Kuwait and Qatar were upgraded from emerging market bond index to the developed market bond index. And what the fears were that when that happens, Qatar and Kuwait will be dumped, and the EM managers, and this is going to cause a lot of pressure on the pricing and the funding curve, etc. But what actually happened, it broadened the investor base for bond investors and fixed income investors in the GCC, because now you have both developed market investors and emerging market investors participating in this market, and at size, as you said earlier, oversubscribed transactions, a lot of activity. And what's interesting to point out is that here in this region, you look at, for example, risks and geopolitics, oil, what's happening, that's not reflected in the funding levels. And for example, you look at credit default swaps, CDSs, as a proxy for risk. The GCC issuers, their CDS levels are between 50 to 70 basis points. That's an insurance, right, on default. Whereas, for example, other EM markets, BRICS, that you hear a lot about, Brazil is over 130 basis points. Turkey is over 200 basis points, right? So this region is pricing at developed market levels, where it is a core part of international flows and fixed income strategies across the board, across EM and developed market bond investors.
All right, and just to keep it short because of time, with all what we discussed today, I mean the market drivers, the themes and so on, what are your insights, or maybe what is your investment strategy? How can an investor translate all of those into a concrete investment strategy for this year? Jason?
In a brief, since the major focus this year is the regulatory change in the foreign investor, I think large market cap will serve as a safe haven and the main target for international capital. Also, the small to mid market cap might offer a very good upside, as after we saw
it was hammered last year.
Yeah, after what we saw of heavy correction last year in many growth stocks. So the main goal is to balance the liquidity between value and growth stocks and focus more in high conviction name and strongly localized demand.
Thomas?
I think what's prudent for this year is to create a matrix between, let's say, top-down macro themes which will benefit and also bottom-up winners. So if you had to sort of tailor a portfolio, it'll be something like a barbell portfolio type, where you have structural growth stories which will keep compounding. And on the other end, you have tactical momentum plays which benefit from regulatory and other initiatives like FOL, QFI, etc. So that would be a prudent way to sort of play this market, because you'd want access and you'd want exposure to both sides of this market. So a barbell portfolio strategy.
And Abdullah, what do you think?
Again, taking the fixed income perspective, I think the way I would look at it is I would target a return of potentially maybe 7.5%. You'd build 30% in sovereigns. That's going to be your anchor, but that's not where you're going to generate all your returns, because that's going to be around 4.5%, 5.5%. Another 30% in corporates and investment grade, where you generate between 5.5 to 7.5, and then I'd put the remainder of 40% in bank-issued capital instruments, tiers 1s, 81s, and tier 2s, where you'd get between 6 and 7, and with that you get a blended return of 7%, with very low risk and heavily weighted on sovereigns, and even the non-sovereigns are in systemically important sectors like banking. That's how I do it.
All right, and I usually like to conclude the panel with two simple questions. The first one would be, what are the most important factors investors should watch in the coming 12 to 18 months? And I really appreciate a very, very short answer because we're out of time. Thomas, you can go ahead.
CapEx and where capital is flowing and trajectory of earnings.
All right, and Jasmine?
U.S. Policy direction and even the oil price.
Abdullah?
I'd continue focusing, seeing interest in these subordinated credit instruments relative to senior to see how foreigners are they really spooked about this region, or is it all clickbait and headlines?
And with everything that's happening in the world in the coming couple of months, what should we look for? Thomas?
Geopolitics and oil prices.
Definitely. Jassim?
If I want to focus on Saudi Arabia, I might say, as I mentioned earlier, Saudi Arabia has entered a new era of financial accessibilities where the kingdom opens its arm to the global equity. This is not only a policy tweak, this is a fundamental structural shift.
All right, and Abdullah?
I'd continue to watch. There's about 10 billion of refinancing of subordinated debt coming in the next few months. That's going to be very interesting to watch because if we continue to price it at the tight levels that we see in the recent past, it's going to be a huge vote of confidence regardless of what's happening in the news.
All right, thank you so much for my panelists, and thank you everyone for listening, and I hope you enjoy the rest of the conference. Thank you.